Welcome to the CryptoCounsel podcast. I'm Frank, and here with me today are two very special guests. One you've heard from before, Duane Pozza, my colleague here at Wiley, who specializes in privacy and telecommunications, media and technology matters, and Steve Boms, the founder and president of Allon Advocacy and the executive director of the Financial Data and Technology Association of North America. One of those significantly longer, more acronymy than the other, but both very pertinent to today's topic, which is about open banking, something that, Steve, I know you are all over and doing a lot of work on. Duane, you as well. This is a little new for me, and I'm excited to learn more. Duane, you want to maybe just set the stage for what we're going to be talking about today and how it relates to some of your work. And actually, before I do that, let me let Steve introduce himself a little bit more. Steve, do you just want to tell our listeners who you are and what you do and how you sort of come at this open banking issue from where you sit?
Happy to do it, Frank. Thanks for the invitation, and always glad to share a platform with Duane. So I run a consulting firm that works with financial technology companies. Our firm specializes in both market and commercial consulting, but also in public policy consulting. And FData, which is the shorter version of the Financial Data and Technology Association, the trade association that I run, is a consortium of about 36 financial technology companies. They do all sorts of different things. Some of them are intermediaries, so they don't work directly with consumers. Some of them do offer their services direct to consumer, whether that's investing help, savings help, personal financial management tools, peer-to-peer payment platforms. And some of them work with small businesses. But the thing that they all rely on to provide whatever service or product they provide, and the reason why we're all here, is they depend on the ability of you as the end user to share access to data held at a financial institution, whether that's your checking account, your savings account, your credit card account, your mortgage, your auto, whatever the case may be.
Awesome. So with that, now, Duane, do you want to set the stage? I know there's a tweet in particular that caught your attention and spurred the idea for this, so I don't want to steal your thunder.
Yeah, thanks, Steve. Thanks, Frank. Yeah, so just as a way of getting into how open banking relates to crypto, just a little bit of context. On July 19th, so pretty recently, crypto entrepreneur Tyler Winklevoss sent out a fairly notable tweet that really highlighted developments in open banking and linked them to crypto. He flagged the open banking rule that was recently issued by the CFPB that, quote, gives you the right to access your banking data via third-party apps. He sharply criticized opposition to the rule, and he argued, and here I'll paraphrase a bit, that its opponents want to take away consumers' ability to access their banking data for free using third-party apps, and to undermine consumers' ability to link their bank accounts to crypto accounts in order to use fiat currency to buy crypto. So there's a lot to unpack there, and we're hoping, Steve, that you can help us walk through it. Maybe we can start by zooming out a bit before getting into the details of that rule. I mean, you can tell us a bit about the concept of open banking that's being referenced and discussed there.
Happy to, Duane. And this is a 7-hour podcast, right? Because there's a lot to unpack here.
It's actually part one of 7 hours. Part two will be 7 to 8, depending on what the budget we get.
My apologies to your listeners. So, Duane, happy to do it. Let's maybe zoom back out to the year 1998. The overwhelming majority, the sole way that consumers interacted with financial providers was through their banks, right? Or through their brokerage accounts, or through their pension providers, right? Traditional financial institutions. Then this thing called the internet comes about. And in the late 90s, you start to get more technology-driven financial services that are offered to you in digital ways. At the very earliest stage, it was no different than if you've ever gone to a financial advisor, you basically have a shoebox full of receipts and statements, and you hand it over to the financial advisor and you say, tell me what to do, right? Here's everything I've got. Tell me where I am and tell me what to do. And in the early days of what was then data aggregation, it was just digitizing that. It was making that exchange of information a lot easier. Over time, a whole bunch of interesting products and tools were built upon that. So if, for example, you decide that you wanted to use, back before it was shut down, mint.com, right? The very straightforward online budgeting tool. Show me everything I have and everything I owe, and then I'm going to make a budget based on that. And maybe I'll get some recommendations about paying off debt more quickly or putting money into a savings account or investing. fundamentally, what mint.com needs is it needs to know what accounts you have, how much you owe, what are your interest rates. It'll categorize some of your transactions. So you can see, for example, like you're spending $1,000 a month going out to restaurants, or you're spending $200 a month on streaming services. And it'll give you very straightforward recommendations, right? Like, Steve, you want to save money? Stop going out to eat so much, right? Or maybe you don't need Hulu, Netflix, and Prime Video. Pick one and you can save $100. And then there are all sorts of tools like that that have come to fruition over the intervening years. Until the mid-2010s, Duane, this data transfer was all conducted through something called screen scraping. And it was all at the permission of the consumer. So you would raise your hand and say, I want to use mint.com, or I want to use whatever the tool might be. And I want to connect my checking account held at some financial institution to Mint. And you would give permission to the tool that you were opting into to access your online account. So it would log in as you. It would use software to kind of scrape the information from that screen required to fuel the use case. And it would see basically the same screen that you and I see when we log into our online banking portal. And it was, okay, so here's how much Steve has in his checking account. Here are his recent transactions. Maybe here's the last 6 months of transactions. We can build a history. And that was it. In the mid-2010s, several large financial institutions began to raise significant concerns about the safety and security of that practice of screen scraping. For one thing, they didn't love the idea that in order to make it work, Duane, you had to hand over your username and password to a third party to access the data. And then they also didn't love the idea that once the keys to the kingdom were handed over, that all of that data was available to the third party. And so there was this kind of transition that the FIs sought to make to what are called APIs, which is a fancy acronym for more secure gateways that just allow two systems to talk to each other through a kind of dedicated portal. That transition was not an easy one. And there are various different kind of commercial tensions in the marketplace, which is how we get to kind of the CFPB, the rule, the regulation that was referenced in that tweet. So Duane, maybe I'll stop there because, as you can probably tell, I can go on about this forever.
I'm just interested in learning more about how I can reduce my streaming service bill from $200 or probably even more than that to something less. But seeing as how the subject is open banking, we'll stick with that as part of our less than 7-hour deep dive. One key statutory provision that hooks into the framework that you're describing is Section 1033 of the Dodd-Frank Act. That came about in 2010, part of a much bigger, more comprehensive piece of legislation. But that is sort of the key statutory provision that a lot of this is flowing through. Can you talk a little bit more about what that provision says, a little bit of the history from when it was enacted to today, and how it sort of leads up to the CFPB's personal financial data rights rule?
Of course. So in 2010, of course, Congress is fixated on addressing the underlying causes of the 2008 financial crisis, on instituting better investor protections, and generally in thinking about how to reform the financial marketplace writ large, because there was an understanding, and I was on the Hill at this time, that this was a once-in-a-generation effort to reshape regulation in the financial services sector. So huge bill, Frank, right? Tons of different titles and chapters. Section 1033 is one very small but very important part of it. And so in Section 1033, Congress, which realizes at that point that there has been this type of information flow happening in the marketplace now for about a dozen years at this point, writes this statute that says, subject to rules prescribed by the Consumer Financial Protection Bureau, or CFPB, a financial provider must make available to the consumer or their representative financial data in the control of that data provider. And effectively, the CFPB sits on that for the better part of 10 years, right? Nothing happens from a rulemaking perspective. And to be fair to the CFPB, as I kind of alluded to before, there wasn't really a need for regulation because the market was generally providing for this access pretty well until 2015-ish or so, when you start to get this push from some financial institutions to move over to APIs. But this was kind of a dormant statutory authority the CFPB had on its plate, and which has now become the flashpoint that kind of led to the tweet that Duane referenced before.
Yeah, so that's interesting. So as you point out, there has been a trajectory here over a decade or so where 1033 exists as a statutory provision. The market is developing. Around 2015, you talked about like a bit of a transition now to APIs. And I wonder if you could talk a little bit more about that. Then also, this is about when crypto starts to enter the picture, right? And how the market develops and how this, begin to talk about how this intersects with the crypto angle.
Yeah. So look, 2015-ish rolls around, right? And it is absolutely true that there was just more adoption of technology tools and financial services. So crypto certainly is one of those use cases, but to be clear, it's one of many. And I think, Duane, to be fair, that's one of the primary reasons why a number of large financial institutions decided that it was time to move away from screen scraping and towards APIs. But the way that that was generally positioned in the market to the third parties, all of whom, by the way, are orders of magnitude at this point smaller than the financial institutions that we're talking about here, was as such. It was, look, fintech or crypto firm, we as the data provider have concerns about screen scraping. We have safety concerns, we have security concerns. Our regulators, our potential bank regulators, are starting to get worried from a third-party risk management perspective. So we are going to switch. As of some date certain, we are going to start blocking screen scraping. Right? We're not going to allow you to get access to the system the way that this has been working for the last 15, 17 years. Instead, we're going to build this API, and you're going to have to access it. But here's the rub, and here's the source of tension, and here's why the Bureau crafted a 1033 rule in the first place. To get access to that API, you need to sign an agreement with us as the data provider. And that agreement will give you access to the data, but it spells out a ton of other provisions around the requirements of getting access to the data. If you talked to the third-party community who were presented with those, what we colloquially call DAAs or data access agreements, what they would say is there really wasn't any choice for them, right? They had a binary choice. One was sign this agreement, get access to the data that they need because their consumers or users depend on it. Choice two was don't sign and lose access to all data held in accounts held by that financial institution. And so these types of agreements start to proliferate. And fundamentally, over the intervening several years, you see a significant number of accounts switch over to APIs. And I think the last count I saw was, as of today, it's something like 114 million consumer accounts in the US are now on APIs. There's a really important distinction, though, Duane, not what you asked, but just like an interesting kind of corollary to all of this. For all of the attention that I have spent, the regulators have spent, the market has spent on this question, we are fundamentally talking about maybe the largest 20 financial institutions in the United States. For all of the other 9,000 plus FIs that exist in the US, this is not at all a priority, right? They've got significantly other more important things to focus their limited resources on. So it is a really important, but really kind of small group of players that have been kind of working on and thinking about this for the last several years. And of course, from a crypto perspective, many of the crypto wallets and crypto firms rely on a data intermediary, a data aggregator, in order to connect your crypto wallet to your bank account, in order to fund the wallet and to take money out of the wallet. And in the absence of that guaranteed right to have that data connected electronically, you lose the ability to fund the wallet or to take money out.
So that kind of leads to recent events that I think also prompted the tweet we referenced, which is, can you just give an overview of what the current status of the rule is? It was issued at the sort of end of the last administration, but ... What comes next?
I'll go even a little bit farther back, Duane, which is the process was started under the first Trump administration. So then CFPB Director Kathy Kreininger puts out an advance notice of proposed rulemaking on Section 1033 towards the end of the first Trump administration. And so basically that ANPR says, look, this market is not functioning as well as it should be. We're going to explore whether or not a regulation is needed here under Section 1033 of the Dodd-Frank Act. There's an election in November of 2020, the administration changes, and then the next head of the CFPB, Rohit Chopra, says, look, we've reviewed the answers to the Kathy Kreiniger ANPR. We're convinced there needs to be a rule here. And so in 2023, they propose a regulation. Really important to note that they're getting hundreds of comments throughout this process back from all different sorts of stakeholders, incredibly consultative process, right? And everything is posted publicly, and so you can kind of see what everybody's telling them. As you referenced, in October of 2024, just a few weeks before the 2024 election, the Chopra CFPB finalizes this rule. At a high level, the rule says this data belongs to the consumer. It is theirs to access for free. There are requirements for third parties that access the data around data security, data privacy, risk management, things like that. But fundamentally, once you raise your hand as a customer of a bank and say, I want to share my data with this crypto company, with this fintech, so long as that company is doing all the things the rule requires, your bank must give the data over to them. Within just a few hours of the publication of that final rule, a consortium of large banks, a bank trade association, sues and says that this is an unlawful rule under Section 1033. Not surprisingly, because this was the same administration that issued the rule, the CFPB in 2024 says we're fighting this and we are convinced that this is a lawful rule. The 2024 election happens. The Trump administration takes office in January of 2024. They immediately announce an across-the-board pause as they evaluate kind of the state of everything, which is typical in any change of administration. They ask for a stay in this litigation so that they can continue evaluating this. And there was a delay in even appointing a head of the CFPB for about a month into the Trump administration. Ultimately, in May of this year, the CFPB says, look, we've reviewed this and we agree with the Bank Trade Association. This is an unlawful rule, and they asked the court to vacate it. There was a real uproar, Duane, amongst kind of all of the kind of third parties in the ecosystem, whether that's crypto, whether that's fintech. The retailers and merchants kind of got on board because they accept pay by bank, which is a cheaper form of payment initiation than interchange for them. And so the sum total of all of that outreach to the administration resulted in a pretty stunning turn of events just a few weeks ago, where the Trump CFPB then submitted a motion to the judge to basically pause, right? And instead of asking the court to vacate the rule as it had been for the last several months, to say, look, we are going to have to reopen this rule, right? We continue to have some concerns about its lawfulness, but there have been recent market developments, including at least one financial institution that is now proposing to charge for this data access, that make us now think that this rule needs to stay effective until we can amend it. And that's a really important point because they didn't ask the court to toll implementation of the rule. And so as things currently stand, because of the CFPB's change of heart, this rule will start to be implemented July 1 of 2026 for the largest financial institutions. So they will have to give this data to third parties at consumers' direction for free, unless and until the CFPB amends the rule. And we also understand that in tandem with this, the CFPB is preparing to issue another ANPR, asking questions about the marketplace and whether amendments to the rule are required both under the law and their interpretation of the law, but also because of developments in the market.
So I just want to make sure I have the state of play correct in terms of where we are now. Are we talking about the 14 major financial institutions on the one side, and then on the other, the fintechs, the crypto companies, other third-party providers that rely on access to this data? Is there anyone else on the bank side of it that's sort of pushing for this new rewrite of the rule?
Ultimately, all of the bank trade associations have now kind of banded together, Frank, to say that they are all aligned on what they view as an unlawful rule. Fundamentally, it's just the 14 largest that have filed suit, in addition to the Kentucky Bankers Association, one bank in Kentucky, in that litigation. Now, in the market, there are certainly financial institutions that take a much more, in my view, kind of forward-looking approach to this, because fundamentally, if you're a bank, you have the most to gain from an open banking ecosystem, right? Like, the thing that you don't have today is the ability to see what your customer is doing in their other banking relationships. This would give you line of sight into that, so long as your customer gives you their consent. So if I am Bank A, and I know that, Frank, you don't have a credit card with me, maybe I can ask you for permission to see your credit card account held at Bank B. And I can take a look at it, and then I can come back to you and say, hey, Frank, by the way, we've analyzed your last 1 year of spending history on your Bank B credit card. You would have saved $500 with us between interest and fees, right? Or you would have gotten all of these additional benefits. And because you already have an account, signing up for an account with us is a breeze. Like, click these 3 things and you're done. So the financial institutions have that scope and breadth and scale in existing consumer relationships. And there are many that see that and have really leaned into it. But it does feel a little bit like folks are now taking sides, where you've got the financial institutions on the one end and basically everybody else on the other side.
So what does this mean for this being the rewriting of the rule, or the potential rewriting? I mean, nothing's set in stone, but certainly the trajectory seems to be heading there. What does that mean for crypto companies in particular?
It's a little bit too early to know for sure, Frank. So this is all reading tea leaves a little bit, right? We are only now at the pre-ANPR stage, which for your APA nerd listeners is like the very, very first step, not even the first step in rule writing. So what I expect we'll see is a whole bunch of questions that give us a little bit of insight into what any rewrite of the rule might look like. Generally speaking, though, there are 2 different views of this, right? So on the financial institution side, the view is that they should be allowed to charge to enable their consumers to share access to data, for example, to a crypto wallet, that they basically should be able to have the ability to decide whether or not a third party, including a crypto company, is too risky for their consumer to share their data with. And they should be able to exert control over the ecosystem. On the other side, if you are a crypto provider today, you generally think the status quo under the existing rule is pretty good, right? It gives your users the ability to share their data with you and to connect their accounts seamlessly. It provides a prohibition on any financial institution charging a fee for that privilege or right. It dictates exactly what the requirements are for you to be what's called an authorized third party in the parlance of the rule. So what do I need to do in terms of data privacy, right? What are the limitations on how I can interact with this data? What are my data security requirements? What does disclosure look like? How do I collect consent? It provides a type of compliance consistency that businesses like. And in the absence of that, I think there's a very real fear that it will go back to a market-driven approach where each financial institution might get to dictate that based on the terms of an underlying bilateral data access agreement.
And Steve, I want you to know that our firm is home to a large number of APA nerds. So they will be listening to this podcast and excited about the term of endearment that you've shared with all of us. So a lot of APA nerds here that proudly tout their nerddom. So, I mean, this is really interesting because I feel like it feels like a small thing, but it has these potentially large consequences that are still very hard to define. But before we sort of make this a little too one-sided, I mean, I have seen some of the things the banks say about why the rule ought to be rewritten, and I'm just interested in some of your reactions to some of those things. So what I've seen, some of the arguments that are out there are they should have the ability to charge money for access to this kinds of consumer data because they incur fairly large costs associated with the infrastructure to give this access. And they also argue there are potential privacy or security concerns with allowing access without any sort of fee structure, which is a little bit at odds with what you had just described. But you know, I'm sure there's some crosstalk there too. So can you just sort of address and maybe contextualize some of those arguments and just tell us kind of what you think and maybe why they are not the right way to steer the debate around this in terms of where this conversation ought to be going?
Well, on privacy and security risks, Frank, the easiest and most uniform way of addressing those is through a regulation that applies to all third parties that seek to access the data and creates a floor that's regulatorily prescribed and enforced for all third parties. And that's exactly what the 1033 rule that is effective right now did, right? And so that argument doesn't hold water from where I sit, because in the absence of a 1033 rule, and remember, the institutions are trying to vacate the rule, right? They are not even in favor of this rewriting that the Bureau is doing. The absence of a rule unquestionably lowers the standard for what security and privacy look like in the open banking ecosystem. On the question of fees for data, look, there's I suppose there's certainly an argument to be made about what's right or wrong, but let's think about what a corollary looks like in kind of other similar marketplaces. A corollary might be you want to take your records from a hospital and share them with your doctor's office. And the hospital saying, hey, that's no problem, but we charge X dollars for every data field, right? For every test result. Or let's say you did your blood labs, right? And you've got 30 different blood lab tests that they did. It'll be $1.50 for each one of those blood lab results that you want to send. Just, highlight the ones you want to send and we'll send those over. It's also the case that this is just a cost of doing business. It would be like your bank turning to you and saying, like, look, we're happy to mail you a statement every month, but you're going to have to pay us for the postage and then for the time that it took us to stuff the envelope. In our view, it's no different than just the 21st century equivalent of sending that information in the mail. The world has changed. Technology has evolved. Most people now don't get that information on paper. Most people don't create spreadsheets for themselves or balance their checkbooks by hand. Most people manage their finances technologically. And so this is the 21st century infrastructure through which this data is shared, much like it was mail in the previous century.
Yeah, it strikes me, we started talking about the history of open banking and getting into 1033, talking about a very different world with a far small number of financial providers. There's a big competition aspect to 1033, in addition to the sort of consumer data rights piece. And I'm interested if you could talk about that a little bit more, without turning this into the 7 hours, but how the interest in competition plays into the policy behind 1033 and also what the rule is trying to get at and the rulemaking.
Yeah, it's a great call out, because competition was one of the explicit rationales for former Director Chopra when he finalized the rule, and also for former Director Kreininger when she first started it. I think the easiest place to see the competition angle is in the payment sector. It's just like a very kind of straightforward approach to it. It used to be that the only way that you could make a payment as a consumer was through a check, through cash, or through a debit or credit card. The advent of payment platforms like PayPal and in later times Stripe, Square, Trustly is that now you can make payments electronically directly from your bank account. So if anybody's paid a utility bill, like I have to pay my municipal water bill every quarter, they will let me use a credit card, but they'll charge me a 5% fee for doing so. But if I want to pay through a pay by bank tool, it's free, right? And so that is obviously what I choose to do. That payment option is directly competitive with credit or debit, right? Every time you swipe your credit or debit card, you are generating revenue, typically on a per swipe basis, a minimal amount of revenue, but in the aggregate, quite a bit for a data provider. And so from a competition perspective, I think the CFPB has said it's probably a good thing to keep prices down in the payment sector if there are alternatives to credit and debit and check writing, which is a vector for fraud. And so the ability to have access with the consumer's consent to their account number and routing number and payment information enables that use case. If you think about any number of like third-party tools, so investment tools. I mean, I am a little bit older now, and I remember when if I wanted to buy or sell a share of Amazon or Boeing, it cost me $19.99 per trade. Over time, it is now free. And that's not because any regulator stipulated that it must be free or Congress passed a law that says, hey, it's got to be free. It's because technology-based brokerage firms came to bear and they started to compete directly with kind of legacy investment houses. And the legacy firms were losing their customers to the E-Trades of the world, right? And so pricing went down. It's exactly the same here. I can't tell you, Duane, I don't think any of us can, 20 years from now, what innovations will take place in the crypto world, in the payments world, in the personal financial management world. But I know that there will be, right? And I know that in some cases, they will compete directly with what your bank today offers you. Maybe it's in lending space. Maybe it's in the financial advice space. Maybe it's in the currency space, right? I don't know. Ultimately, enabling access to this data electronically allows for that competition to take place in a way that lowers pricing and forces incumbents to compete in ways that spur innovation that otherwise might not happen if we kind of tend more towards oligopolistic or monopolistic tendencies.
So in the spirit of not going on our 7-hour tour, I'll skip over debanking, which is another thing that sort of intersects with all this, or maybe sits atop it. And maybe, Duane, I know obviously you and I and others at the firm have been following a lot of the legislation that's getting passed through Congress and that's on the Hill. Do you want to speak to that and ask Steve a little bit about that?
Yeah, I think as you were talking, Steve, I was also thinking about the Genius Act and what that's opening up for payment stablecoins. And suffice to say, that's an entire episode that we'll have to have in terms of what that kind of competition that will be unleashing. But taking that as an off-ramp to crypto, the state of legislation right now on the Hill, there has been a lot of momentum around crypto legislation, see the Genius Act. There's still more to come. Do you see that these open banking issues have intersected with that? If they have not, do you think that they should? Or why do you think they have not taken as much prominence as some of the other issues going around crypto frameworks?
Yeah, look, to be very blunt, I don't think the kind of crypto industry really awoke to the importance of this inarguably kind of esoteric rulemaking and statutory provision until very recently, like within the last 4 to 6 weeks or so. And so as a result, most of the crypto legislative conversations happening on Capitol Hill were really about fundamentally very specific crypto or stablecoin related regulatory structure questions. I think that's changed quite a bit. And it honestly doesn't help that a lot of this kind of came to fruition right as Congress was leaving for their annual August recess. And so there haven't really been a lot of conversations over the last couple of weeks on Capitol Hill. So I think it may change, Duane, right? I think, for example, the Clarity Act is now kind of where a lot of attention is going to be turning on the Hill in terms of crypto bills. And so I think there is the potential for Financial Services Committee and Senate Banking Committee members to start thinking about what are the key drivers of the crypto marketplace, what is required to enable safe, secure access to the crypto marketplace, digital assets more broadly, stablecoins. And the underpinning of it is access to this data, right? And so I think there is a world in which you could see this move along. On the other hand, there is now, again, we're in a pre-rulemaking stage, but there is now this kind of regulatory process that will be kicking off imminently. Historically, Congress tends to kind of sit back and watch those processes play out and then only intervene if at the end of that process, they believe that there's been some error. And so it would not surprise me, Duane, if Congress monitors this, and to be clear, they are, but basically says we're taking a hands-off approach because we feel like we've given the regulators all the tools they need under that 2010 provision of Dodd-Frank, and let's see what they do with it, right? And we're happy to kind of come in and see if we need to give them more authority based on what they come up with. But until then, this is their thing to figure out.
Yeah, Frank, I know you guys have talked more about advocacy efforts on previous episodes. Maybe we can talk more about how those intersect.
Yeah, I mean, so Steve, we had someone from Coinbase and Stand with Crypto on the podcast, and they talked about the political activation of the crypto voter and the issue as a highly salient issue in the national election cycle. And it feels like we're just in persistent election cycles, even though obviously the next one is a few years away. But do you see this open banking issue among crypto companies, the fintechs, and others that are aligned in the space that you're operating, pursuing this as using political advocacy, doing some of what we've seen from Stand with Crypto and Fair Shake and others to try to activate voters around some of these concerns? I mean, I will say that this is, if described directly and properly, this is a pretty practical, real issue for Americans, probably more so than just the larger, just what does the crypto industry mean for the country? It's a very specific thing that people can wrap their minds around, and it seems to have an impact on how you go about using technology in your daily life. So I'm just curious if that's sort of something on your radar, if that's happening, what we could look for in that particular space.
So I think the answer is yes, Frank, but I'm also going to contradict myself a little bit. So it's a little bit more challenging than a traditional advocacy campaign, and here's why. Open banking is infrastructure, right? It's no different than electricity. You or I or Duane, like maybe you guys do, I don't think about electricity very often, right? When I do think about it, it's when I'm plugging something in, I don't want it to explode. I think about it in the less than 1% of the time when it's not working, right? And I frantically call my electric company to figure out when they're going to fix it. And I think about like, do I need a converter when I'm going somewhere because my plugs are a certain size, right? Or the voltage is a certain voltage. That's open banking, right? Like you don't think about the infrastructure, you think about the use case. You think about the crypto wallet, you think about the investing tool, you think about the personal financial management tool. If something goes wrong, less than 1% of the time, you want to know who to call to make it right. And you also want it to be as interoperable as possible. And so the challenge, Frank, is if this all works, the average person on the street is never going to know what open banking is. They're just going to know like, yeah, I've got a Coinbase account, right? And I can fund it from whatever bank. On the other hand, I think it is an entirely different story if financial institutions do end up starting to charge, right? And so if Jane Doe somewhere in America is now paying X dollars just for the right to connect her bank account to her Coinbase wallet, that will, I think, make folks start to pay attention in ways that could activate them. And there's no question in my mind that the fee issue ultimately will get passed on to consumers, right? And there's no other way that gets paid fundamentally. And so I think we're at a crossroads, right, where you could see some of that activation soon. We're not at the point yet where the consumer has actually started to see that cost, but I think we're not too far away from it if things keep going the way that it seems like it's going.
It's really interesting. Well, I think we've reached the point where we're going to have to put the 6.5 hours that remain behind like a Patreon for our APA nerd community and invite them to listen to the rest of the recording. But Steve, this has been incredibly interesting and informative. I certainly learned a lot. I know that you and Duane operate in this space more, but this to me is the kind of thing that crypto companies, crypto clients, crypto adjacent providers should be watching and paying a lot of attention to, because it really does seem like it has a tremendous impact on where this is all going. Duane, Steve, any sort of parting thoughts or words before we wrap it up?
Thanks, Steve. This has been great. There'll definitely be a lot to watch over the next year as the pre-rulemakings and the rest of the APA process unfold, and more on the Hill. So thanks for that great overview. It's always great to talk to you about these.
Likewise. Really appreciate the invitation. As you can tell, a lot of my waking and sleeping hours are spent thinking about this. So always happy to actually talk about it with people as opposed to just thinking about it.
That was our pleasure. Thank you, Steve. Thank you, Duane. And this has been another episode of CryptoCounsel at Wiley.